Chapter 6 focuses on the master budget and responsibility accounting. In this section, we'll introduce the foundational concepts of budgeting, which are essential for effective financial planning and control within an organization. Understanding the master budget helps us see how various individual budgets come together to create a comprehensive financial plan. Responsibility accounting then links these budgets to specific managers, holding them accountable for their areas. This chapter will give us a clear framework for managing resources efficiently and measuring performance accurately. Chapter 6 focuses on understanding what a master budget is. Essentially, a master budget is an integrated set of operational and financial plans. It combines all the individual budgets from different departments into one comprehensive and coordinated roadmap. This roadmap guides the organization's activities, resource allocation, and expected outcomes. A key concept here is that the master budget not only helps in planning but also plays a crucial role in responsibility accounting, ensuring that each part of the organization is accountable for its performance. Budgeting offers several important benefits that can really help an organization succeed. First, it turns strategy into measurable targets, making it easier to track progress and stay on course. It also aligns plans across different departments, ensuring everyone is working toward the same goals. Another key advantage is that it flags potential problems early, so they don't turn into costly surprises down the line. Budgeting also improves coordination, control, and accountability by clearly defining roles and expectations. This process includes mastering the master budget and responsibility accounting, which together provide a comprehensive framework for managing finances effectively. Overall, these benefits make budgeting an essential tool for any organization aiming for financial discipline and strategic success. In Chapter 6, we're focusing on building the operating budget, which is a critical step in financial planning. The process starts with the sales budget, which is based on the demand plan. This basically predicts how many units we expect to sell. From there, we move to the production budget, which tells us how many units we need to produce to meet that sales demand. Once we know the production needs, we develop the resource budgets, covering materials, labor, and overhead costs required to make those units. Finally, all this information flows into the budgeted income statement, showing the expected operating result. This sequence highlights how each schedule drives the next, ensuring everything is connected in the master budget and supports responsibility accounting effectively. On this slide, we're looking at the key components that make up the operating budget and their supporting schedules in detail. First, we have the schedule, which helps organize all the various elements efficiently. The primary output refers to the core results or goals that the budget aims to achieve. Next, material purchases are carefully planned by estimating the quantities and costs of materials we need to buy. This is crucial because it directly impacts production costs and inventory management. Direct labor is also a vital part, where we determine the required labor hours and the associated wage costs to meet production targets. Manufacturing overhead includes all the planned indirect production expenses, such as utilities and maintenance, which are not directly tied to labor or materials but are essential for keeping operations running smoothly. Selling and administrative expenses forecast the non-manufacturing operating costs, like marketing and office administration, ensuring we account for all business functions outside of production. Lastly, the cash budget plays a key role by outlining the timing of cash inflows and outflows, as well as any financing needs. This helps maintain liquidity and ensures the company can meet its financial obligations throughout the budgeting period. All these components come together in the master budget, supported by responsibility accounting, which assigns specific budgetary responsibilities to various departments or managers. This creates accountability and helps monitor performance effectively. In this chapter, we focus on financial planning models and sensitivity analysis, which are critical tools for effective budgeting. These computer-based budgets allow us to turn assumptions into quick scenario testing, making it easier to understand potential outcomes. We start with input variables like sales volume, price assumptions, and cost drivers. These are the key factors that influence our financial model. the power of these models lies in their ability to recalculate instantly. So, when you change one assumption, you can immediately see how the budget responds, giving you valuable insights into different financial possibilities. From this, we generate output scenarios such as best case, expected case, and worst case, helping to prepare for different market conditions. This approach ties directly into the master budget and responsibility accounting, allowing managers to adjust plans and compare outcomes efficiently. Essentially, these tools enable us to be proactive, making informed decisions that can improve financial performance and risk management. In this chapter, we're diving into the concept of responsibility centers and how managers are evaluated based on the results they can control. Let's start with the cost center. Here, the manager's main job is to keep costs under control while making sure the necessary level of service or output is met. The focus is primarily on managing expenses efficiently. Next, we have the revenue center, where the manager's responsibility shifts to generating sales or revenue. Unlike the cost center, they are not accountable for the costs related to the product or service, so the key emphasis here is on increasing sales volume. Moving on to the profit center, this is where managers are judged on both the revenue they bring in and the costs they manage. Their goal is to maximize the overall profit, balancing income and expenses effectively. Finally, the investment center expands the scope even further. Managers in these centers are responsible not only for profits but also for how well assets are used to generate returns. Here, the focus is on return on assets, ensuring that investments are utilized as efficiently as possible. All of these concepts tie into the master budget and responsibility accounting, which together help organizations align managerial responsibilities with financial goals. Now let's talk about how responsibility accounting works in practice. The key idea is that each responsibility center is evaluated based on factors that the manager can actually control. This means the focus is on measures like cost, revenue, profit, or investment outcomes, depending on the type of center. To ensure managers stay on track, budget-to-actual reports are used. These reports quickly highlight any gaps between what was planned and what actually happened, helping to address issues promptly. Ultimately, responsibility accounting ties closely to the master budget, allowing organizations to monitor performance effectively and hold the right people accountable. Now, let's focus on the human side of budgeting, which is crucial for successful financial planning. First, motivation plays a big role. When people feel motivated, they're more likely to engage fully with the budgeting process and strive to meet goals. Then there's buy-in, which means ensuring everyone involved supports the budget and feels committed to it. Without buy-in, even the best budgets can fail. Communication is key here. Keeping everyone informed and on the same page helps prevent misunderstandings and resistance. Behavioral incentives are another important aspect. These are rewards or consequences that influence how people act with respect to budget targets. Finally, integrating the master budget with responsibility accounting ensures that different departments or managers are held accountable, which helps in monitoring performance effectively. All these human factors together make budgeting not just a numbers game, but a dynamic process that drives organizational success. When budgeting in global organizations, there are several key challenges to keep in mind. First, currency fluctuations can significantly impact costs, revenues, and even target goals because exchange rates change rapidly and unpredictably. Then, there's regulatory variation. Different countries have their own tax rules, reporting standards, and controls, which makes standardizing budgets more complex. Cultural differences also play a big role. The assumptions we make in planning and the ways people participate vary widely across regions, so it's important not to apply a one-size-fits-all approach. Finally, coordination complexity adds another layer of difficulty, as time zone differences and geographically dispersed operations slow down communication and alignment. Understanding and addressing these factors is crucial for effective budgeting on a global scale. To wrap up Chapter 6, let's focus on the key takeaways. First, the master budget is essential because it consolidates all individual plans into a single, coordinated financial roadmap. This helps ensure that every part of the organization is aligned with the overall goals. Budgets also play a critical role in improving planning, enhancing communication, and strengthening control throughout the company. We saw how operating budgets, along with supporting schedules and sensitivity analysis, help transform assumptions into actionable decisions, enabling managers to respond effectively to changes. Finally, successful budgeting requires not only sound responsibility accounting but also an understanding of the human factors that influence performance. This balance is crucial for meaningful and realistic budgeting outcomes.